access, quiz access.
Okay, I'm gonna go to
Okay.
the office because I know other students are gonna watch. I don't want to mess up with your video with
Oh,
all
no,
my noisy house.
oh, it's not that noisy. Let's see. Okay, so if we go to 6, 6 is where they provide a variety of transactions and then ask you to journal them. So
Mhm.
there's going to be a combination of debits and credits associated with this.
Okay.
And so let me kind of do this a couple different ways. I like to, whoops, not that. I want Excel. I want a new version of Excel. Actually, I don't need a new version of Excel. I can just use this. Okay. Let me just make this a tad smaller so I can see the whole thing. Okay. So this first one is actually, it's already right there. I can make it bigger so everybody can see it. There we go. Okay. So it's already right here. It's
Okay.
saying that T. James, the owner, invested $18,000 in cash in Sustained Company exchange for common stock, right?
So on that one, we are gonna put cash, and it's a debit of 18,000.
Correct.
And the second one is gonna be common stock. And
Yep.
that's where I'm not sure if it's debit or credit.
Okay. So the magic here usually is if you know one, you know the opposite, because debits and credits need to equal on your journal entry. Okay,
Okay.
you can't have one side of all the debits. Let's say you have 3 or 4 different line items for debits and they total, I don't know, 100,000. You have to have $100,000 worth of line items on the credit side too. So this one is pretty simple because it's just a 2-line transaction. So you already knew the cash side. That was the easy part, I think. And you already knew the common stock because it gave you the, basically gave you the account. So
Yeah.
then, since you knew that cash was a debit, then common stock would be the credit.
Okay, so 18,000 was credited to the common stock account.
Correct. And common stock is an equity account, right?
Mhm.
And so to increase an equity account, you would credit it
Yeah.
because a credit for an equity account is an increase. A debit to an equity account is a decrease. Just like on the asset side of the equation, really, if you cut the balance sheet in half and you've got the assets on one side and you have the liabilities and equity on the other, those pretty much give you a sense for where the debits are and where the credits are. So the debits are usually, almost always, a
Mhm.
normal debit balance, and the liabilities and equity are almost always a normal credit balance, right?
Yeah,
So
almost, because sometimes it's not. I
only a
remember.
few. Yeah, there's a few accounts here and there that are contra accounts or they have the opposite, but on the asset side, it's basically accumulated depreciation. And on the equity side, it's mainly dividends and treasury stock. Those are usually the ones that are just the opposite. But for the
So
most part,
should I have also in mind the same thought, thinking, when I'm doing the T account, the left side is debit and the right side is credit. Do that apply for here too?
yes, these are basically T accounts, but just they're aggregated T accounts, right? So
Okay.
instead of a T account just for common stock and a T account just for cash,
For
it's
everything.
combined, right? So, if you put a T right here, you'd have the same thing, debit and credit. So you always want to make sure the total for both debits and credits are equal. And so in this
Okay.
case, you got $18,000 in cash and 18,000 in common stock. Okay. So now on
Hmm.
the next one, the company purchased $11,000 of furniture, which is an asset made
Mhm.
from reclaimed wood on credit. Meaning, if you buy something on credit, your credit card, right? You owe somebody else, right?
Exactly.
So if you
So
owe somebody else, then it's a liability.
yeah, so it would be the furniture account. No, yeah, furniture account would be debited 11,000 because it's the value you got.
Correct.
And accounts payable would be 11,000 as well on credit, right?
Correct.
Hmm.
Yep. Let's check our work on that. See how we did.
I always run out of check work. We need more than 3.
Yeah, absolutely. I hear you on that. So we'll go back to that. So definitely we got the first 2 right. We're good.
Yeah.
So let's try another one. The third one, right? The company paid $2,000 in cash for a 12-month prepaid insurance policy on the reclaimed furniture. So
That's not the same furniture, right? That they just paid 18,000 on it for it.
I think, yeah, we can assume it is. It might not be, who knows, but it really,
It's not gonna change the numbers then.
yeah, it's not going to change the numbers. You really, what they're trying to test you on here, or at least give you some practice on, is that you have a value, $2,000. That's the easy part, right? Debit and credit.
Okay.
You know you're going to have a debit of 2,000 and credit of 2,000. So the question is, what accounts
It goes
are
to
associated with this, right? So if you
prepaid
paid,
insurance is it's asset, right? I don't know.
correct, prepaid insurance is an asset. So it's something that you own. If you were to cancel, then you don't have, then you get the money back, right?
Yeah.
But for every month that you use it effectively, you have less of a prepaid insurance. So if prepaid insurance is an asset, then what do you think the journal entry looks like?
Well, I think it's not gonna have a prepaid insurance thingy on the drop
So
down menu.
okay,
Oh, it's a
let's start
debt.
with it.
We're
Sorry?
gonna we are debiting 2,000 on that account, the prepaid insurance.
Yep.
And I know, is it expenses or
No, it's going to be cash. Because
oh,
remember, you
cash
still
is
have
gonna
cash. Yeah. You're
oh,
only,
okay,
in these ones, you're only going to have 2 accounts. It's either,
okay. So
right.
we don't think about monthly, we just think about what happened in that moment.
Yes, that very specific transaction. Because in the future, yes, you'll have an expense, but that
Mhm.
expense it'll be a debit to the expense account and a credit to prepaid because you're reducing the prepaid amount for every month after that.
Okay. Okay, so then it's gonna be cash credit 2,000.
Exactly. Yep. So that is that one. So one more, we got number 4, the company billed a customer $10,000 for sustainability services. This one
Okay,
might be a little tricky.
so
We'll test this one out, but
so they sent a customer a bill of $10,000, right?
yep, yep.
So that's account payable. No, sorry, receivable.
Receivable, definitely receivable. Yep,
Yeah, accounts receivable 10,000 debt 10,000.
yep.
And I don't know what the second one, what would it be?
Okay, so sustainability services provided, that's going to be usually a revenue type of an account. That's income that you're receiving, right?
So
Just, you know,
services.
like when you work, the company's going to pay you something, so it's what they owe you. In this case, your customer owes you money for something you've done,
So
and
services revenue.
this is going to be definitely revenue. So the question is, just have to find the right revenue account, and in this case, because it says services, we're going to use services, okay?
And then
And that's going
credit.
to be $10,000.
Okay, and that's what it gets me, because I'm still receiving 10,000 for the services revenue. Why is it credited 10,000 and not, like what I'm talking about? It sounds like it's going negative 10,000 and not positive, but I think if they're gonna pay me 10,000, so I should be debiting, it should be positive. So I'm sorry, it's dumb, I know, but it gets me.
No, that's the hard part, because in real life, if you will, credit is used synonymously for all sorts of different things, right? And
Okay.
so when you get to accounting and you try to apply it, it gets confusing because some people think, when you get credit, it's something that you're getting money back. Or if you got a credit, maybe it's a reduction, and a debit is a addition, right? And
Yeah.
that's usually the main concepts that most of us have. But in this case, you gotta think about it from a balance sheet standpoint. Okay. So revenue sits on the equity side of the balance sheet because it flows through to retained earnings and it increases retained earnings. Revenue
Mm.
does. So an increase to retained earnings is a credit because it's on the right-hand side of the balance sheet, and credits increase those accounts. So revenue is a credit.
Okay.
Okay.
Yeah, it sounds to me that it's more like a memorizing thing. And
Yeah, it's a practice.
yeah, 'cause I can't memorize anything. I'm gonna fail big time in the test.
No, you'll be fine. You just have to keep in remember. I forget somebody posted something on one of the support chats that I think it was Deer. I forget. Anyway, for me, it's always just been left-hand side is debits, right-hand side is credits. You just
Mhm.
think of that, look at the balance sheet and think about the balance sheet. All assets are on the left side and all liabilities and equities on the right side. So as a basic kind of thought, debits on your left side, credits on your right side. There's only a few exceptions. And so then you
Okay.
just have to remember the exceptions. And right now they're not testing you on the exceptions except for one. They're only testing you on the normal balances pretty much.
Okay.
And probably the one exception that they're testing for is probably this next one.
Uh-oh.
Nope, not this one. We'll get there, I'm sure. Okay, so the company paid $11,000 cash towards the payable from the June 2nd furniture purchase.
Yeah, so in June they paid 18,000. Oh, they bought 18,000 furniture on credit, right?
Yep.
So now we are gonna have cash credited
Nice.
11,000.
Yep, cash is credit. How much is that?
11,000.
Okay, perfect.
And okay, the two for so the furniture costed 18,000 and they paid no, so it's still gonna be 11,000. So would we debt 11,000 on the furniture
Yeah, the
account?
furniture is an asset account.
Uh-huh.
It's like, you're sitting in a chair right now, right? That asset's
Uh-huh.
going to be there whether you pay it off or not. So you don't want to change the value of it, but you may change how much you paid on your credit card. So if you
Okay,
paid your credit card off, how much do you owe the credit card company?
nothing.
Nothing. So how do you take it from, in this case, the $18,000 minus the $11,000, right? How do you get that $11,000 off your credit card account?
So I'm still gonna owe 7,000.
You're still going to owe 7, but you don't need to worry about that here. You're just trying to do the transaction that you paid it, right? You paid $11,000 off. So on your statement, you would have originally saw an $18,000 charge, and then you would have seen a payment for $11,000, right? And the net of those is 7,000. But what does that $11,000 show up as, and what account does it show up on here?
So I would say oh no, it's not furniture then.
No, not furniture. That's
Uh,
the asset. And
oh,
this is a key work. This is a key
oh
word.
yeah, accounts payable.
Exactly. So accounts payable for the
11,000.
$11,000. So now if you actually looked at it, you would see the $18,000 back here. Let's see if we can find it.
It was the first one.
18,000. Oh no, this is the
Oh,
investment. They
yeah,
bought it for
sorry.
11,000.
It's so they paid it off. Okay.
Yeah. So they paid it off, but when you look at it, the furniture, if you look at a T account,
Uh-huh.
the initial purchase would be $11,000 credit, and
Uh-huh.
then the cash payment would be where'd I go? Sorry, $11,000 credit. I was looking at the wrong one. Right, accounts payable is $11,000 credit, and then when you paid it off, it's an
It's switched
$11,000
side.
debit.
Yeah,
So the
switched side.
11,000 is showing up on both sides and it zeroes out.
Yeah, it's balanced.
Yep, it's balanced and it's zero.
Okay.
So now this number six, number six, the company collected, this is important, $10,000 cash for the services billed on June 4th. So you
Okay.
billed it. Now the question is, you got paid. What's the journal entry for that?
It's the accounts receivable.
Definitely. Yes, accounts receivable is there. So is that a,
So in this case,
pretty good.
it was debited in the accounts receivable. But are we gonna do that, like, it's gonna be cash or accounts receivable?
You're
The
gonna
name of
have
the account.
both. You can have both of
Oh.
those accounts. So the
Oh,
question
okay,
is,
so
which one comes
cash-
first and which one comes second? You know, what's
I
what's
can't,
the debit, what's the credit?
debt come first, then credit, right?
The credit is going to be to what?
No, so we should record debt, then credit, right? That's the order.
Yes, debits first, then credits. Yep.
Yeah, that's what I was thinking.
But when you're doing this, for me,
Hmm.
I always do the first thing that comes to my mind and then I correct it.
Oh,
Right.
okay.
So for,
I would start with that debit. I would say cash account 10,000.
Yep.
And then accounts receivable, I would credit 10,000.
Oops, wrong number.
Yep, 1 0 less.
Yep. Perfect. That's exactly what you would have done. Right,
Okay.
because your original entry to record the receivable was a debit, and then when you get paid, you're going to credit it. So it nets out to zero, and now that cash shows up in your cash account, right? The revenue from that service goes to accounts receivable first, and then it moves up to cash when you actually get the payment.
Okay.
Okay. 7. He invested an additional $17,000 cash in the company in exchange for common stock.
So that would be the same of the first one. Cash debit 17,000 and common stock credit 17,000.
Yep. Perfect. And then the last one, the company received $12,000 cash from a client for sustainability services for the next 3 months. Here's the trick. Well, it's not really a trick. This one may throw some folks off. It's not the one about a normal balance or normal debit or credit balance. Doesn't get in that one, but this one could be a little tricky for some.
Okay. Yeah, I did that one. It was tricky for me. I think I probably missed it. So they were paid 12,000 in cash. Service for the next 3 months. So it's a prepaid, right?
Nice. Yep.
Yeah, and so
should be prepaid. It'll be actually it'll show up as unearned revenue.
Unearned revenue. Oh, okay, yeah, I didn't get that one right. I would have never thought of that.
Yeah.
So unearned revenue, there is a credit of 12,000, and then when they provide the services, you would like switch sides, right?
You would, when they provide the service, then they would debit unearned revenue and credit revenue, service revenue. So it'd move it from a liability. So let's say you didn't actually perform the services. Well, it's a liability. Until you perform those services, you still owe your client the $12,000 back, assuming that they say, we're done.
So unearned
that's why it's a
revenue
liability. It's a liability initially, and then when you actually perform the service, then it gets debited on the liability account and credited on the revenue account.
Okay, that makes sense.
It still stays on the right-hand side of the balance sheet, right? But it's just moving from a liability to an equity, really, retained earnings. flows through to retained earnings as equity.
Got it, got it. Can we, I don't know, do I have a limit of time?
Yeah,